Yes. Thank you for sharing your evening with me. I am JB Bryan, President and Chief Investment Officer at JB Bryan Financial Group, the home of AfroEconomics. And I am talking about tonight a historic moment. Historic in that the market dropped 800 points. And when I say the market, I'm talking about the Dow Jones Industrial Average. So we did a little bit of extra calling tonight because by tomorrow, my phone is going to be off the hook. So it's like, because hopefully I'm going to help those of you who are taking the time out to participate tonight. The people that will have to call are the people who weren't able to participate tonight. But that's a privilege and that's an advantage of AfroEconomics, that we get to communicate so freely. Stocks plunged today. When you see that, they're talking about generally the Dow Jones Industrial Average today, the worst performance of 2019, after the bond market sent out a signal about the economy. Isn't that something? The bond market impacted the stock market. Who would have thought, right? But it's interesting because the powers that be are desperately looking for any suggestion, any indication. Remember, I was telling you about artificial intelligence, where there's so much stuff that's being kept in computers now that when they can find things that might connect together, then they're used. So what is being used is that a movement in the bond market of an inverse relationship with short-term and long-term, then all of a sudden, which they're supposed to, the long-term bonds are supposed to increase on their interest rates over time. So when all of a sudden your long-term rates are going lower than your short-term interest rates, then it's an inverted yield curve. So I'm gonna try to share this with you because I sometimes say these things and I'm like, hey, let's allow technology to help us. So can you see this right here? I got this from CNBC on their website. I hope you can see my pointer. This right here, this purple line, the purple line, you see it. The purple line is the 2-year interest rate. Think of it as like that on a 2-year bond, the interest rate that it's paying. This yellow is the 10-year bond and the interest rate that it is paying. And at this point in time, 6 a.m. this morning, the bond for the 10-year, the interest rate paid on the 10-year, called the yield, is below the short term, the 2-year. So that's not supposed to be like that. Even though it didn't stay like that, it got there. So look at this. And I'm just going to pull it from here. There have been 5 inversions in the 2-year and 10-year yields. That, what you just saw, has happened 5 times since 1978. And all were precursors to a recession. But there is a significant lag. Like, this is a stretch, but we're going to let them have it because they've accepted it as true. That within 22 months after this happens, a recession in the market occurs. Isn't that something? 22 months. And because of that, they're arguing that we are, because of that inversion of the short-term rates for that short period of time, but that's happened 5 years since 1978. And every time within 22 months, our economy has slowed down dramatically, hence causing that 800-point drop. What does that tell us? That the market is sensitive to information, just like last week. I don't know, it seems like, it was last week, 700-point day over stuff with China. So we have this, that makes this topic so important because amazingly so, you may discover that a lot of people who have exposure to the stock market have no idea that they have exposure to the stock market. So one of my key points, and we're talking about 10 things I think that you should know as a stock investor, is that you need to know what you're doing. You know, there's so many people that will say, oh, well, I don't invest in stocks, I just do mutual funds. And they have a mutual fund that is made up of the majority of stocks. So isn't that like, you know, that is, you know, interesting that so many people have no idea of the exposure that they are actually getting to stocks because they think that because they have mutual funds that they don't have any stocks. But they're right, they do not have individual stocks, but they still have stock market exposure. Celia, can you grab that light right there, this one, and just like pull it over to the side? I don't know why, but it's bothering me, that right there, and like turn it off. Let's do that. Yeah, watch that. There's somebody, no, I'm sorry, the button's over here. Right there, yeah. Boom. Right? There was somebody out there who's like, I'm so glad she turned that light off. Aren't you? Like, I am a little darker because the light is out, but just seeing it, that right there, right? So like somebody's telling me, no. Did you like it? Did you like the light? Maurice, you can't just say no. So then let's go back to my key points. My key points of things that I believe that you need to know. Now, we've talked about the inversion, the inverted yield curve. If you have any questions about that, please ask me again. I mean, and then I should look at my notes. And going back, I do have in my notes what a yield curve is, but you saw the picture, a yield curve from textbook is a line plotted out yields, a line plotting yields across maturities. So when I was talking about the interest rates will be on the top line, and the terms, 1 year, 2 year, 5 year, 10 year, 30 year, will be across the bottom. So as you're going over in time, the interest rates will go up. But when it gets inverted, you're going in time, and the 5 year is higher, and they're saying, and then your 10 is lower, or the 2 year was higher and the 10 was lower at that point in time. So that 10 is not supposed to be lower on the lower point of the curve, of the interest rate curve, than the 2 year. And if that happens, they're saying that it is a representation of a slowing down of the economy, hence stocks, companies struggling, especially banks and financial institutions. They were hit the hardest, struggling to increase their profits. And so let's know that I'm sharing that story to explain the speculation of what happened today, of what was behind the 800-point drop. But I'm also sharing that point that making money in stocks is not easy. It not only requires a lot of patience and discipline, but it also requires a great deal of time to research and a sound understanding of the market, the things I'm talking about. So that's how stock mutual funds became popular, because they were for the average person to turn that responsibility over to a manager of the mutual fund. But now we know, we're smarter, that's not enough for you as a smart investor. And that's why, our regular sessions are so important, and that's why seeking professional assistance and having a financial advisor to get you in tune with your specific risk tolerance, your specific goals, can be beneficial. So my first point of these 10 things that I think that you should know as a stock investor is to understand stocks and understand stock mutual funds. My second point is to make an effort to keep your losses on your stock investments small and your profits big. This means that you have to learn to be impatient when it comes to allowing your investments to lose money for you. And you would be amazed at how many times I see people in their company stock. And I go, well, this stock, you've got like 50% of your retirement in your company stock, and it hasn't done anything over the last 5 years or the last 2 years, and they're very patient with that. Where it's like, but you can be, just say, for example, doing this XYZ, index that, and doing better than that historically, than this particular one. But we become very patient with losses and impatient about how fast we think that things should be zooming higher, on good, sound, diversified portfolios. So it's like, instead we need to really, realize that it is time. Sometimes it's time to get rid of that loser. And it's okay to be impatient about it, because you want to make sure that you cut your losses in something. And if they've proven that this is a loser, it's time to cut your losses. A third point is buy great companies at the best price. Make that like your philosophy versus buying average companies at a cheap price. And for us, I believe that we're really guilty of that as a people. Like, I see that too often, that we'll be excited or doing some sort of online account where it's like 25 cents and you bought 1,000 shares at 25 cents a piece, and you're really excited about it, but that's buying an average or below average company just because it's cheap. Instead, buy quality investments. Put every penny counts. Every penny counts. So it's not okay. So buy a great company at the best price over an average company at a cheap price. And if you don't understand what I'm saying by that, then you really need to talk to me before you consider, or talk to your financial advisor, and that is licensed in assisting you and looking out for your best interests. A fourth point is, don't get emotionally connected to your stocks. As I was saying about, with the company stock, and, you want to be in the company or whatever you have. I've been there 30 years, you've been there 40 years, I've always had that particular utility or whatever, and it's forever. You're emotionally connected instead of focusing on the fundamentals and what we expect from that particular investment. I remember about 20 years ago, this client, her company had given her all these stocks, and they didn't give her anything. She had worked there so long that when they did a particular merger, she was provided with her what she had earned over all those years. So it ended up being at $100,000 in this particular new entity that would have been created. And I explained to her that that's too much money. That's too much money in this one particular, position that doesn't have any historical performance, because this is new. This is new, and they're hoping that it's going to work and this and that. And you got a lot. And she said, "Oh, it doesn't matter to me. They gave it to me anyway." And I said, "Well, they really give it to you. That you earned this. This is, part of your compensation. This is your money." It went from $100,000 to $3,000 for no reason. No reason. If she had just allowed me, the same clients that did the same thing but diversified, that still have money today. And then number 5, never give up your advantaged position. And I don't even know why I love that phrase, but it applies to like everything in my life. So it had to be in this. Never give up your advantaged position. You know, if you're in any position of advantage of an investor, don't just give it up just because. This is where all of the discipline, comes in. And sometimes we do things, and this is only applicable in AfroEconomics, but I got to keep this real. We give up our advantage position a lot. Like, just say the company is giving you stock. If you work one more year, you are fully vested. And then you say, I can't stand this job. And you only have 6 more months. And then you're going to be fully vested and you're going to get their match onto your retirement account. And you leave. You gave up your advantage position because of emotion. Because of the, whatever, if you're like, look, the way I see it, unless your life is threatened, you cannot, Mr. Bozeman, I don't know if you agree with me, but you cannot give up your advantage position. Like if they write you and they say, I want to give, we're buying back our stocks and we'll pay you this and this amount of money. And you just sell it back to them because you just want that money because you want to buy some outdoor furniture. Well, first you need to talk to your financial advisor about why are they trying to buy it back? Is this bad for me? Why is she, why are they doing that? So don't give up your advantage. And then let me go back to your notes. Mr. Bozeman says, reminder that you are a fiduciary, so your loyalty is to your client, not to any company. Exactly. I do not work for any product, and I am a fiduciary. I have to operate for my clients under contract or my members under contract in their best interest and not have conflicts of interest either. Yes, indeed. Thank you, Karen. Karen said, keep speaking facts, JB. That helped me. Thank you. And then Mr. Bozeman said, I agree that we need to think beyond our emotional response of the moment. Yes, we do. Maurice said 100% in agreement. Mr. Bozeman, make sure you send me your information on your blog. So that I think there might be a way, I don't know, I will have to, but I will share it with everyone. If you send it to me, I'll cut and paste and I'll send it. It has a really powerful blog that it was really nice and it has some information in there, Black Health and Black Wealth, that I think is great. And so so let's go back to my points. So so that was never give up your advantage position. See, it was applicable. Number 6, proper research should always be undertaken before investing in anything, including stocks. Proper research, investing in anything, right? Investing in your friends and investing in anything. Research. Research. Yeah, I mean, I know people who have invested in companies in their. Because when you're in the stock market, you're just buying shares of ownership of a company. So you have a friend that comes up to you and they go, I'm starting a business and I want you to put up some money. I want you to invest in my company. And you don't understand it. I had this one lady, she was starting her own business and she was trying to raise money. And I was trying to explain to her what she was doing because her lawyers had not really explained to her what you're doing when you try to do a private placement and raise money from people outside of your company, or just even if they're inside your company, if you're trying to get even your employees to invest in it, you got to understand what you're doing. But then we as the investors or potential investor, you need to do the proper research. Anything from Google, Microsoft, Amazon to XYZ company and Leroy's Shrimp Track, invest it. Research, see how they make money. What do they do? A seventh point is that never invest in a stock. Invest in the business. So I'm just saying that when you buy stock, you're not investing in stock, you're investing in the business. So when you invest in the business, you have to understand that the company before you invest in the company. And that I kind of went into when I was talking about do the proper research, but don't just look at it as, you know, I own this stock. Realize that you own a piece of that company. And how well is that company doing? How will that company continue to make money in the future? What is their, you know, what is their future of this? How is it scalable? Can they, you know, really add on more people? Can they really sell more products? If so, how can they? How will they make more products? How will it be? You know, will it get better over time? Is this going to become outdated? You know what, you know, so that's definitely look at the business. And then the thought that you know, can always catch the bottom and that you're always going to sell at the top is like a myth. Like, you know, they say, you know, buy low, sell high. You know, that's, you know, it's basically impossible. And for the people who really try to do it the hardest are the ones who seem that they're the ones who lose the most amount of money. You know, especially those who are like, I better get out now. You know what I'm saying? I better get out now. They generally are getting out when it's tanking. They're not getting out at the top because the top is going to be really quiet. You know, it is. And the bottom just seems to just kind of ease in there on you. This could be, I mean, this could be the bottom, but it could be the top for somebody. So I think that number 9 is what makes it, let's move away from trying to catch the, you know, bottom and buy low and sell high and I know I've got it and, you know, setting up the system and this is the exact time. But instead, let's focus on number 9, that we have to be systematic, even automatic about our commitment to constantly investing. And so that and develop a commitment, also just a love for delayed gratification. That the thought that today's 800-point drop will mean nothing to you, will mean absolutely nothing to your children, should be what really excites us. Like, wow, look at that. Look at that. Oh, glad I got my cash right. So, or glad I'm always investing. Woo! So be disciplined and be systematic. And get really into delayed gratification. I think that we can teach our children anything. We can teach them that everything takes a process, just like getting through school, just like getting through life, just like learning to, you know, run a marathon. You know, everything takes a process. Investments work the same way. Even if this is true, where this inverted yield curve is telling us that in within the next 2 years, if it's right, that we're going to be seeing a slowdown, what is that message to us? As I've been telling you from day one, we have to be committed to keeping our money right. This is, you know, everything that we're putting into the stock market is not for today. So if I'm terrified about a stock market drop today, then I have my money invested incorrectly, because my stocks are not for 1 or 2 years. My stocks are, you're putting money for your stocks, your stock money, your money in stocks is for the performance 10 years, maybe 5, preferably 20. It's your long-term, Joan. That's what it is. And then my final point would be we need to constantly monitor what we're doing with our investment portfolio, but we need to constantly monitor what we're doing with all of our money and get help if you need it. I mean, it's just so real. Now, is that number 8 or number 9, delayed gratification? Thank you for asking me that question. I throw a number 9, I said discipline, systematic approach, and delayed gratification. Look, I put it all in there. I did. And then number 10 was constantly monitor. I'm glad you asked that because I was like threw it all in, didn't I? I did. How does one do? Mr. Jones says, how does one do proper research? You hire me. That's what you do. But other than that, you know, you just got to let your fingers do the walking. You got to say, I'm interested in this, and then continue to look deeper and deeper and deeper. And you say, I like the way they do things, you know, based on this criteria, you know, maybe historical performance or their low amount of debt, or, you know, have your own criteria of what you're looking for. And then, you know, research, only invest in things that you understand and that preferably where you spend a lot of money on, right? Are there rules to engage to help to not become emotional about your investments? Ladies, see, I would say yes. It would be these 10 rules to make sure that you are systematic, make sure that you are invested according to, and part of that systematic, and that you're following a procedure and a process of delayed gratification is to discover what your specific risk tolerance is. And when we discover what your risk tolerance is, every stock has a risk score according to my artificial intelligence, you know, software and information that I use. So if we do a risk analysis, you know, it should help that we're choosing things at least we have a strategy or a rationale behind it. Everything that we would choose in the portfolio that we select. And I do focus a lot more on portfolio development. I have the AfroEconomics 10, which is for a portfolio for a person who wants to have individual stocks. But I definitely, I'd like to, I encourage you that the more that you know, those rules, Lady Singh says, are there rules to engage to help to not become emotional? I believe that the more you know, the less emotion will become involved. I also believe that people that have a partnership, that have a financial advisor, that people are the members of AfroEconomics, because they have someone else to call. Like I remember in 9/11, you know, and my clients, we did a quick, you know, and I would consider that like the original AfroEconomics members. We immediately did a call when all of that went down, and they closed down the stock market for a while. So clients couldn't sell, you know, in their if they had investments that were connected, where everything was connected, because you couldn't sell anything. You couldn't sell your mutual funds. You couldn't sell, you know, anything. So, oh wow, Lady Singh said she's gonna sing on the 14th. You are so good. We're gonna think of something. You're gonna sing on the 14th. Something. Black Health, Black Wealth. We're gonna be moving. We're having a day party, and you're gonna sing something we can dance to. That's what you're gonna sing. We're gonna get us up. Get up. Check out, everybody, to all panelists and attendees. I sent the link to functional forgiveness. And why do we always have to be the ones to forgive? Very good article by Andrew Bozeman. And definitely, did you all see that? I know, Ms. Hayes, you will really appreciate this. Really, really appreciate this. And that all of you will. I'm gonna go over my points real quick before y'all leave me, but we're talking about the 10 things that I believe that every stock investor should be aware of or thinking about is that you have to first understand stocks and understand stock mutual funds. Get that understanding. Keep your losses small and your profits big. That means being impatient with your losers. Got to know when to hold them, know when to fold them, know when to walk away, and know when to run. Number 3, buy great companies at the best price over average companies at a cheap price. We got to stop being so cheap. Don't get emotionally connected to your stocks. 5th point, never give up your advantage position. 6th point, proper research should always be undertaken before investing in stocks. Number 7, never invest in a stock. Think of it as a business. Don't say I'm investing in stocks, even though I just said it. But invest in the business. Understand the business. Invest in a company that you believe in, that you know. No, the 8th point is don't believe the hype when it comes to buying low and that you're gonna, catch the bottom. And that you're going to be selling at the top. Catching the top and the bottom, is just a joke. And most of the time, most of the people who tried to do that have ended up doing far worse than people who do number 9. Have discipline, have a system, and are into delayed gratification. And then, because then they don't have to worry. They just know this is what I do. I invest my money. I save my money. I'm committed to this over the long term. When they're in that, when they're in that zone, they don't have to be obsessed with, is this time to sell? Is this time to, is this the bottom? Get that system down. And then number 10, that we need to constantly monitor all of our money, but especially when you're talking about stock investing, monitor your individual stocks, monitor your portfolio, and then seek a financial advisor that is licensed, to assist you with the needs that you have. Like a lot of times people go, oh, I want to buy individual stocks. And then you call upon a person who's only licensed to do mutual funds or only licensed to do insurance products. So if they're not licensed to do the particular thing, then, you are cutting yourself out, and they're only going to tell you about that, and they're going to sell you on that point. So make sure you know who you're dealing with. And as Mr. Bozeman mentioned early, it could be great to deal with a registered investment advisory firm, because generally I know I am 100% independent. We're not connected to specific products. We only serve you. Then we select the product that's best. Mr. Bozeman said, at some point in the future, will you discuss how savings fits into our portfolios and what happens to bank savings and interest rate? What is happening? And this is interesting, with this long-term, interest rates, going down on this, there's a lot of pressure on banks because interest rates are going any lower, and lower interest rates makes it harder for them to make money. And also, lower interest rates are harder on safe investors. It's harder to find security. It's harder to outpace inflation. If you're a conservative investor and interest rates continue to go lower, then you're going to sacrifice, because if inflation is at 2% a year and you only want to have a savings because you don't ever want your money to go down, then that can be a challenge. Right? So, definitely we continue to talk more about savings and the challenge for our retired people to have safety, but to also have growth, and how to, I think that we as a people really focus a lot on saving. And I really thank God that you are coming to AfroEconomics, because hopefully it will help us close that wealth gap by looking more into investments. And I realize that my daughter will benefit more from everything that I'm doing then I will do, because that's what we have to do for delayed gratification. The full benefit for our community is that we have to do that first principle of Afroeconomics, realize that our legacy, is everything. That's, that legacy is vital, that we have to think generational, versus just the security for us, this one generation, but we have to think of, if our next generation has that portfolio at the beginning of their life, what an advantage that they have, right? Even savings and no debt, what an advantage that is. Well, any more questions for us? How you doing, Terrence? Good to see you. How you doing, Miss Potts? Yes, indeed. Valron in the house, Paula, Monica. Yes, indeed. I see y'all. Dr. A, we need you at Black Health, Black Wealth. We want you to talk about mental health. So you're gonna have to get in that car. Come on down to Virginia. I'm gonna call you. Hi, Miss Potts. You're so sweet. Thank you. All right, Demetrius. Yes, indeed. Mr. Jones, you need to come on September 14th and talk to us about that. You were talking to me about, let me see, what the first thing and the last thing was. Artist Jones said, life, prosperity, and health. That's what he wished upon all of us. Yes, indeed. And he said it in his own way, but I'm not going to jack it up, artist. He'd be like, what? But indeed, thank you. Thank you, Monica. Thank you for everything. Please, this is going to be recorded. We have saved it. Life, health, and prosperity to all of you. Thank you. Thank you. Oh, no, thank you. Have a great week. Check out that article that I sent to you all from Mr. Bozeman. Just do a cut and paste, copy that. You'll enjoy it. One day I might need you to forgive me. Forgive me. I forgive you. Love you all. God bless you. Let me go down. It says we got one more new message. Oh, bye. Bye. Bye, beautiful yourself. Thank you, Lady Singh. Don't forget, September 14th, everybody. It's getting close. Ms. Davis. Thank you. Yes. I'm not going anywhere, y'all, for a minute. Y'all go ahead. Thanks a lot.